Don't set a high escrow minimum unless you have to. If you're buying a building, if your sole purpose in the offering is to raise $20 million to buy a company and the price is $20 million, then you don't have any choice, right? But the problem with doing that, of course, is you have a lot of expense before you get to close escrow. It just gets very cash flow negative until you close escrow. So wherever possible, have a zero minimum. That is the norm unless you're buying an asset. Don't set a low maximum raise, set a higher maximum raise, because there could be some pleasant surprises for you during your 1 year offering, like it was easier to raise the money than you thought, or that you have an acquisition opportunity that's come along and now you can fund it more easily, et cetera, et cetera. So set a higher maximum than you need. There is no reason to set a lower one. And then you don't have to hassle with trying to change that post-offering. Don't waste time with tier one. Probably in 2020, we'll find that 2% of capital raised via Reg A Plus was in tier one. Virtually nobody does it anymore. I won't dwell on that, just avoid tier one. 2 year audits are required. 2 year audits are only required if your company has been around for 2 years. You know, if your company has existed for a year, then a year audit is fine. Some people get confused by that. NASDAQ does require that companies which list Reg A Plus IPO companies that list on the NASDAQ have at least a 2 year operating history. So, you know, you can't have done something else and then come along and form a brand new entity that has no history and go public on the NASDAQ via Reg A Plus. If you have a history, that's a good thing in order to support that transaction. The biggest single mistake to avoid in Reg A Plus, I would say the two biggest mistakes to avoid really. One is self-serving, very self-serving, which is don't do it yourself. You know, we have this frustrating experience from time to time with companies that approach us, and there's characteristics that they show as they go through it that I recognize now. And I call them do-it-yourselfers, and very few of them end up succeeding, basically. So I recommend not doing that. Use the professionals. We're good, we're great. I'm biased, but there are other companies out there doing this as well. I would recommend that you work with experts rather than do it yourself. The second big thing to avoid is doing a Reg A Plus when you shouldn't be doing it because it's not going to work. You know, if it's too hard to explain your business, you can, if you have a company that's solid and is difficult to explain, then you can raise money via a debt offering that pays an attractive dividend, preferably monthly. Then that's can be a good way to go if you can carry that, if you're ready to do it, and if you can carry that burden. And some companies will make a reserve for a few years in order to be able, against capital raise, in order to pay that dividend. That's the case where you've got a company that's solid but boring and hard to explain, hard to motivate people to invest in. But my point is that it's really important not to waste your time doing an offering that is by definition not going to succeed. That's where we add a lot of value up front. The last thing we want to do is help you do an offering that's preordained to fail, right? What's the point? We're all about doing offerings that succeed and where the investors will celebrate that they participated later. That's it. Those are our two biggest goals, and I'm sure they're yours as well. Setting a high per investor minimum. A lot of companies that haven't done a Reg A Plus come from, you know, it's sort of the higher the minimum amount, the better it feels, perhaps the more credible your company is. You know, it feels good to have a high minimum when you're dealing in Reg D. But in Reg A Plus, the dynamic when you're marketing, and again, this is almost always the case, we're marketing a raise to lots of people who they were doing something else, and they see a social media advertisement which appeals to them, and they parachute in for a few seconds to look at the offering. Now we've got to quickly show them that what they thought they were going to see, they're seeing, that it's compelling and exciting, that it's credible. They're allowed to do it, they're allowed to invest in it, and that the amount of money that the minimum amount that they have to invest is play money for them, right? So if you set the minimum to be per investor $5,000, it's the kiss of death. The vast majority of people that will parachute in, if they see the 5K, they're gone and they're not coming back, because that's more than play money. They might come, if they were hypothetically to stay the course and stay involved and like it and love it, they might invest 5K later, but we've lost their attention forever already. So have a low minimum, like $200, $300, $400, in order to lose the minimum number of engaged investors. And then they'll invest, and then they'll monitor it, and if they like it, they'll invest more. And then in a few months, they might come back from their managed IRA and invest a heck of a lot more. That's what tends to happen. So that's one, I covered that item adequately. Let's see. Yeah, avoid big name, expensive law firms. Many of them don't know Reg A plus and charge a lot of money and take a long time. We want people that are experts in this space. That's what we do. We specialize in bringing the service providers in that know what they are doing and are cost effective and time effective. Absolutely avoid big name auditors, because they may never get the audit done. We had one company planning a New York Stock Exchange IPO. The NYSE loved the company. It was one of those unusual companies growing at a very rapid clip and highly profitable at the same time. You just don't see that very often. And yet they were irreversibly attached to having Deloitte do their audit. And there were two non-US entities and a US entity. And this company was too small for Deloitte to get out of their own way. And they never did get an audit done in time, a simple US GAAP audit. And in the end, the board told the CEO to can the whole idea, and he did. Had no choice. He'd lost credibility with his board of directors. Big name auditors, very expensive. Another practice you see even in mid-range auditors is coming in and bidding a price for your US GAAP audit, which is not complex theoretically, and then jacking up the price when it's too late for you to switch. Because if you switch to another auditor, guess what? You have to start all over again. They can't depend on the work done by the prior auditor. So be careful with the auditing side of things. We have great auditors that we recommend that aren't going to do that kind of thing, obviously. Expecting to only raise money in the US is easier generally, and then it's not that easier, not so much easier, because a lot of people outside the US would love to invest in US companies that they might not otherwise get into. So expanding your reach and getting the marketing agency to do so is big. Using debit and credit cards is not risk-free, especially credit cards, because the investors can go back to the credit card company and ask their money back. But it's a heck of a lot easier for the investor to invest when you take debit or credit cards. So it's a good thing to do to make it easier, reduce the marketing expense. In my view, the way I look at it is, if you've got an investor that wants their money back and you're allowed to give them the money back, give them the money back. You don't want squeaky wheels out there that are unhappy, but easy for me to say, right? Remote control, no, it isn't all going to happen on its own. There's a lot of work involved internally. We'll coach you through the relevant learning, especially front-end loaded. How are we doing on time? We're doing fine. Don't neglect social media. The primary online source of raising capital is through social media advertising. The lovely thing is that when people like it, they'll share your ads. It's a lovely dynamic. The bad news is there are people out there that want to poison the well, and they will. And you need to expect that there'll be some amount of time involved in responding to genuine questions in social media and on the offering page, obviously. But social media is where the problem lies, because there are people who, for some reason, want to poison the well, make allegations that aren't justified, really create a negative vibe. So it takes a proactive, positive, engaged effort on somebody's part on the team internally to engage with those folks in order to manage that. You can't just delete the messages, because the SEC says, hey, you want to market this stuff? It's open forum. If somebody's got a legitimate criticism, that has to stay public. You want to have the praise, you want to have the shares, you got to have both sides of the coin. Another aspect that the SEC cares greatly about is equal information. So we'll help you with that. You know, if you answer a question that's an awkward new one, before you answer it, you got to decide, do I want to answer this? Because I'm going to have to publish the answer and the question so everyone gets equal information. So, you know, that's a useful filter, but that's a detail to get into more than we need to right now. You can change this, if it's a share offering, you can change the share price during the raise. If it's a debt offering, you can change the terms of the debt offering during the raise with proper preparation. The SEC is more responsive. They're doing a faster job of turning around Reg A plus offerings than prior to COVID. And I'm digressing into COVID for a moment. And the cost of marketing our company's offerings is lower than before COVID, significantly, 8, 10, 12% less than it used to be. So that's a very positive dynamic. It makes sense when you go and study what's gone on in the past, especially in China, where they've had more lockdown type activities with viruses in the past. In each case, there was a surge of increased activity with online businesses, which sustained thereafter. And we're experiencing that because guess what? What are we doing? We are taking what was an in-person kind of activity, brick and mortar based, putting it online. It's going virtual, and this is accelerating Reg A plus and other aspects of online investing, crowd investing, if you will.